Hi everyone. In this video, we are going to unpack one of the foundational concepts in auditing, sufficient appropriate audit evidence. Let's start with the core principle from the auditing standard. The auditor must obtain sufficient appropriate audit evidence to reduce audit risk to an acceptable low level and to give a reasonable basis for the audit opinion. Notice this definition as two separate words doing two separate jobs. Sufficient is about quantity, how much evidence, and appropriate is about quality, how relevant and reliable that evidence is. We will look at each of these two pillars in turn, followed by dedicated real life example for each. Sufficiency is about quantity, simply how much evidence has the auditor gathered. Two things drive how much is needed. First, the risk of material misstatement. The higher the risk in an area, the more evidence the auditor needs to feel comfortable. Second, the quality of the evidence itself. If the evidence is very high quality, the auditor may need less of it. But there's a critical rule to remember. More evidence can never make up for poor quality evidence. 10 weak documents don't equal one strong document. Let's look at real example of this one on the next slide. Here's a concrete example of sufficiency in action. Picture two inventory audits. First, bags of cement in warehouse. They are low value per unit, easy to count, and not something anyone is likely to steal or manipulate. So this is low risk. A sample count at just a few points in warehouse gives the auditors enough evidence. Now compare that to a high value jewelry inventory. It's portable, high value per unit, and a common target for theft and fraud. So this is high risk. Because the risk is so much higher, the auditor needs far more evidence, more test counts, more locations, and the tighter observation of counting process. Same objective, confirming inventory exists, but very different amount of evidence because sufficiency scales with risk. Now let's turn to appropriateness, the quality side. Appropriateness covers two things: relevance, meaning does the evidence actually address what we are testing, and reliability, meaning can we trust it? Reliability itself depends on three things: the source of evidence, external versus internal, the nature of evidence, is it document, something the auditor observed directly or just a verbal statement, and the circumstances under which it is obtained, such as whether it was created under strong internal controls. The key rule here is evidence from independent external sources is generally more reliable than evidence generated internally by the client. Let's look at a real example next. Here's a concrete example of appropriateness in action. Suppose the auditor needs to verify company's cash balance. On one hand, there's a bank confirmation letter sent by the bank directly to the auditor confirming the balance. The bank is an independent third party with no incentive to misstate the number, and because it comes straight to the auditor, the client never has a chance to alter it. That makes it highly reliable. On the other hand, there's an internal cash report printed from the company's own accounting system. It was prepared by company staff who intentionally or not could misstate the figures. So even though both documents show a cash balance, the bank confirmation is far more appropriate evidence because of where it came from and how it reached the auditor. Let's check out this hierarchy. At the top, the most reliable evidence is the auditor's own direct personal knowledge. For example, physical washing inventory being counted. Just below that is external evidence that comes straight to the auditor, like a bank confirmation. Then external evidence the client has on hand, like a supplier invoice. Then internal evidence, which is more reliable when the client has a strong internal control system. And at the bottom, the least reliable is verbal evidence or anything from an environment with weak controls. When our auditors design their procedures, they try to pull evidence from as high up this hierarchy as possible. Let's bring sufficiency and appropriateness together with one final scenario. Suppose an auditor is verifying $1 million in accounts receivable. The strongest evidence here is confirmation letters sent to and received directly back from 80% of the major customers by value. This is high in both sufficiency because it's targeted at the largest and riskiest balances, and high in appropriateness because it comes from an independent external source. The internal aging report from the company's own system is useful as supporting evidence, but on its own, it doesn't carry much weight because it's internally generated. And a verbal comment from the finance manager, customer always pay, is essentially unusable as audit evidence. There's no quantity and no quality behind it. This is exactly how auditors think in practice. They don't just collect more paperwork, they prioritize the evidence that is both sufficient and appropriate. So, to wrap up, sufficiency is about quantity, how much evidence driven mainly by risk, and higher quality evidence can reduce how much you need. Appropriateness is about quality, relevance, and reliability, shaped by the source, nature, and circumstances of the evidence. And the most important takeaway, both are required together. Quantity can never make up for poor quality. An auditor opinion is only as strong as sufficient, appropriate evidence behind it. Thanks for watching this video related to the concept of sufficient, appropriate audit evidence.